Hello, everybody, and thanks for joining us today. Today, the subject is portfolio risk. So, super exciting topic. We're going to go over this one's only probably going to run around 15, maybe 20 minutes. So, pretty short webinar today, but really going to dive into what we call the risk number, the purpose of it, and how you can utilize it, how you can access that, and where you can find all that information. We are going to wait just a minute or so here. We do have a few other individuals that have not logged in yet. So we'll give them just maybe 20, 30 seconds and we'll get this kicked off. Okay, so it looks like most that have registered or joined. So we're going to go ahead and get started. I'm going to kick this off with a quick poll. So what the poll is really about, just how you feel about current risk today, just in the market. Are you very optimistic, kind of neutral, a little concerned, or very concerned? So I'm going to give everybody about 30 seconds to complete that poll, and then we're going to get started on the webinar. Okay, so for those that just logged in, what we're doing here is just a quick poll on how you feel about the market today. Current state of the market. Are you very optimistic, neutral, little concerned, or very concerned? Okay, it looks like everybody's almost voted. All right, thanks everybody again for taking that poll for us. Again, the main subject of today is looking at risk in your portfolio, how to read that risk number, what is that risk number, and where you can access that on the client portal. So I'm going to close out close the poll. You should be able to see our website, and I'm going to show just a quick video to kick this off, just a little bit about the partner that the firm that we've partnered with that assists us with this risk analytics.
Did you know that human beings are twice as concerned about avoiding losses than they are about achieving potential gains? That's one of the reasons humans tend to sabotage their own investing. Selling when they get scared, missing the recovery, and buying back in when the markets feel safe again. That's why your advisor uses Riskalyze. It all starts with a risk number, a quantitative way to pinpoint how much risk you want, how much risk you need to take to reach your goals, and how much risk you actually have in your portfolio. The results are powerful. So how does this work? First, you need to pinpoint how much risk you want. The old way, stereotyping investors based on their age, just doesn't work. Because everyone is different, your advisor may use a questionnaire or use a discussion of portfolio risk to set your target. Once we determine your risk number, we'll set up your portfolio. Your advisor uses your portfolio's risk number and 95% probability range to set expectations for what is normal for your portfolio. Keeping track of your investments this way helps you to understand that any 6-month result that falls within the range is right on track. This enables you to give yourself permission to hang in there, even if markets are volatile. You're going to love how Riskalyze empowers you to become a fearless investor. Let's get started today.
Okay, so most of you have already walked through that process with setting that risk number in our process. So I'm going to go ahead and get logged into the portal. For those that aren't familiar, we go to our website, click New Client Portal, and then I'm going to get logged in. Okay. Okay, so once you get logged in, what I want to do is kind of start from the very high level view and then just kind of dig deeper as we build on the risk number. So When you first log in, you can actually access in two different areas, and I'll show you the first one. If you go to Tools and then click on Risk Profile, so what this is going to show you is that, high level view, what does my risk look at as a whole? So as this pulls up here, again, this is one of our demo accounts. This right here is the current risk of all of the investments that are feeding into our portal. So the current risk is a risk level of 49 with 95% probability over the next 6 months. We would anticipate the performance to be between negative 9.44 or positive 17. So when you highlight this, what this shows here, this number is if it got a 17% return, the value would roughly be 2.262 in that 6-month period. If it dropped 9%, the value would be 1,739,270. So this is the risk number is one of the ways that we monitor your portfolio on a daily basis. So every morning I receive a report which shows the current risk number of all of the investments that are in our portal. And again, I stress all of them that are in our portal. So if you have outside investments that are not feeding into our portal, that is not going to be affected by this risk number. So that's one of the reasons we recommend everybody feeds everything into the portal, regardless if we're managing those or not, so we can really get an accurate picture and make sure this risk number is as accurate as possible for you. So the report I receive every morning shows me what your risk number is currently and then what your goal is on your risk number, because those we want to make sure to be as close as possible. And we have parameters set internally that if those vary a certain percentage, then we go look to rebalance the portfolio, or maybe it was just quick spike of interest rates that moved some bonds, or maybe some major news in the market that may have been a short-term thing that we believe that risk will come back into play. So this is that first high-level view. So when you first logged in, and I'm going to go to portfolio here just to kind of give you an idea. So I have 4 accounts, these 4 here that are in our demo. I go back to Tools, click on Risk Profile. What this is showing here is this is the risk of those 4 accounts. Now, if you go into the Insight tab, so we're going to spend some time in the Insight tab on our next training. This gives you a little bit what I would call that next level view. So one step deeper on the detail. So here on this window here, we have the risk of 49. So same parameters that we just looked at. Now we're looking one step deeper because we have 4 different investment accounts, which are these accounts over here, feeding into our system and showing you what the risk number is of that actual portfolio. So as an example of this one here, this risk of 1, this is a traditional fixed annuity, so we rate that as cash. So 1 is cash, 99 is the highest this risk number can go. The S&P 500 tends to be about 80. So as an example, if we look at this portfolio here, this has about the same level of risk as the S&P 500. This one here has about 25% less risk of the S&P 500, and similar to down here. So on this Insight tab, on this client review, that's giving you one step deeper into what is this risk number comprised of. So as a whole, ours is 49, but we have 4 accounts. One is a risk of 1, 77, 58, and 64. The weighted average of those is how we get to that risk of 49. So this is the number that most clients speak to us and say that they use the most, but gives you that idea of what level or what we call variance you have in your portfolio. So I'm going to go back to this risk profile one more time. So what we tend to strive for is, let's say our downside risk here is, for simple numbers, let's just say that's 10. We want the opportunity for growth to be 1.5 times or greater than this number here. So if our downside is 10, we want this to be 15 or more. That's kind of what we strive for when we're looking at management, 1.5 to 2 times that ratio. But this gives you an idea of what some of you have heard me reference, what I call kind of your investment street. So the larger the number is here, and the larger the number is here, the wider your street is. So what I mean by that is that the more opportunity for swing in your investment. So if this one was -20 and this is +40, you know, we have 60 percentage points between those two. So we're going to have a real wide variance or fluctuation in your portfolio from day to day. The other is in a perfect situation, what you want is this and this here. Now this is current value. So as much as we can shift these 2 points to the right, because what we're doing is that would be reducing risk and increasing return. Increasing return. That's kind of an ideal situation. And what you'll see is as this number decreases, that's when you're going to start seeing a shift of this point here moving closer to that downside. Whoops. Okay, accidentally clicked on the Skype here. Close that out. Okay, sorry about that. So that's where you're going to see some of the changes in the risk number. Now, if you are, let's say, for instance, heavier in bonds or fixed income, you're going to see this risk number change more often when interest rates are volatile. So if interest rates start going up, that can increase the risk in your bonds, which could in turn increase this number here. So that's why it's very important to monitor and manage what our goal is on our risk number and where our risk number is actually at. And that's what we do every day. So I'm going to go back to this insight here. Oops, probably ought to clear all those drawings up. So again, here's our risk number as a whole. This is by portfolio. Now, some of you may want to dive what I would call kind of in the weeds, if you will, and look at quite a bit of detail on that risk number. So as part of your quarterly report, this will be included. But let's say it's mid-quarter, or you just kind of want to get a little bit deeper detail on the risk that's in your underlying investments. So if you go to Documents, then click on Reports, click on Current Risk. Now you can run this for a household, which is what I would always recommend, or you can run it by an individual account. So I'm just going to leave this as the household. We want it as a PDF, and we're just going to download that there. And most reports take anywhere from 30 seconds to a minute or so to create. But what this is going to show you is that real detailed view of here's where I want to be, here's where I'm at, but then also by portfolio what your risk number is, and then also by security. Okay, so here we are, current risk. We have all four of the same accounts in there. And what I pull down here, so what this is showing you here, so if I was on my morning report this morning, it would show that this person is a little below their risk parameters because the goal would be a risk of 53 and we're currently at a risk of 49. So we're about 4 points off, which we look at that as okay. That's not a wide enough variance that we would warrant an action or a change in the portfolio. And then as we scroll down here, so what you're going to see as we're going through these, let me pull my highlighter out, is the bold, and then the next risk associated with it is going to be what this account here, the risk number is as a whole. So up here, we're looking at our variances between negative 9.44 to plus 17. This specific account is a little bit wider because we have a little bit higher level of risk. So it's between negative 13 and positive 22. Now, let's look at GE Electric. GE Electric has a huge variance with its volatility, and these risk numbers change based off of the standard deviation of the security. So they're not always static. So the worst is a negative 30% downside, best is a 48% upside in the next 6 months. Huge variance on this security here. Again, this is the S&P 500 high dividend ETF. -13 to 23. And I'm going to scroll down here. So this is going to show you what every single security that is held in your account, what their current risk number is. So now let's look at that little bit more of aggressive account. Again, bold print is the portfolio. The risk right next to it is that individual portfolio. So this has -17 to +27. Let's scroll all the way to the bottom and we'll pull that fixed annuity up just to kind of give you what that looks like there. So this one here, since we have a guaranteed principal, we have risk of 1. Downside is 0.01, upside is 3%. So that gives you kind of an idea of how we blend different risk numbers together to, at the end of the day, make sure that your current risk is as close to your goal of risk as possible. And that's one of the things that we manage on a daily basis, kind of in the background. And if this moved to, let's say, a 65 shortly, you obviously would receive a phone call from us. Or if it dropped to, let's say, a 35 or 40, major variance between where it needs to be, you're going to receive a call from us, kind of talking about that situation, what caused it, and what we need to do to move that forward. So again, I thank everybody for your time today. I hope you found this valuable on how to use that risk number. As kind of a quick recap, when you first log in, the high-level view, if you just go to Tools and then click Risk Profile, that's going to give you that high-level view. If you go to Insight and click on Client Review, this is going to show you what that risk is per account. And then we could obviously run the report, and that is going to give you the detail of what every individual security is inside of there. One thing to notice is if you do see, let's say you add an outside account to the portal, we'll get notifications on that, and normally it will take about 2 to 3 business days for that outside account to show up here. So if you had an outside account on maybe a Friday, like maybe you want to feed your 401k in, when you add that to the actual portal by Tuesday or Wednesday, that should be live and accurate on the risk number. So it is not instant, because once that comes in, then we need to match those securities up so that way we can keep that risk number as accurate as we can. So again, thanks for your time today. If you have any questions, as always, email those to concierge@centorbifinancial.com. That's concierge@centorbifinancial.com. So thanks again for your time, and hope you all have a great day.